most investors have never heard of this metric. Yet Warren Buffett has used it for over 5 decades to find stocks trading at a fraction of their actual worth. And right now, there are companies sitting on billions in assets that the market is pricing like they're worthless. Today, I'm showing you exactly what they're missing. I'm going to teach you the price-to-book ratio, one of the most underrated tools in value investing. This isn't theoretical finance babble. This is the actual metric Buffett uses to separate diamonds from coal. By the end of this video, you'll know exactly how to find stocks that are trading below the real economic value they represent. And more importantly, you'll understand why that matters. Let's start with the definition. Price-to-book ratio, or PB, is simply the stock price divided by the book value per share. That's it. Book value is what accountants call the net asset value of a company. Take everything the company owns minus everything it owes, then divide that number by the number of shares outstanding. That's your book value per share. So here's the math: if a company has 100 million shares outstanding, owns $5 billion in assets, and owes $2 billion in liabilities, the book value is $3 billion divided by 100 million shares. That's $30 per share of book value. Now, the stock is trading at $20 per share. That means the price-to-book ratio is 0.67. The market is saying this company is worth 33% less than what's actually written on the balance sheet. This matters because a PB below 1.0 means you're buying $1 of assets for less than $1. The question is, why? Here's the critical insight: price-to-book works especially well for asset-heavy businesses where you can actually trust what's on the balance sheet. Banks, insurance companies, manufacturers, retail chains, these are the industries where book value is most reliable. Let me show you what happens when a PB ratio gets genuinely attractive. In 2008, during the financial crisis, something extraordinary happened. Blue-chip companies with fortress balance sheets got thrown overboard. Investors panicked. They weren't making rational calculations anymore. They were selling first and asking questions later. Take Wells Fargo in October 2008. This was arguably the most conservative, well-run bank in America. Yet the stock fell from $34 per share down to $8. Meanwhile, the book value per share was around $11. That gave you a price-to-book ratio of 0.73. An investor analyzing the fundamentals could see that Wells Fargo owned $11 worth of assets and earning power, yet the market was pricing it at $8. That's a 33% margin of safety right there, built in from day one. Now here's what happened next: if you bought at that price and held for 10 years, you made 14 times your money. From $8 to over $110. Not because the market suddenly understood that the bank was worth more, the bank's actual earnings grew. You got both the valuation reset and the earning power expansion. The lesson here is that a low PB ratio doesn't mean the company is broken. It means the market temporarily lost its mind. So how do you actually use this metric to make investment decisions? First, understand what PB ratios typically look like across different industries. Banks, insurance companies, and manufacturers often trade between 0.8 and 1.5. Retail chains might trade at 0.5 to 1.0 because inventory is hard to convert at full value. Tech companies, on the other hand, often trade at 3, 5, sometimes 10 times book value because their assets are mostly intangible. Here's the critical filter: you're looking for companies trading below 1.0, meaning the stock price is below the book value, but only within industries where book value actually means something. Step 1: find a company trading below book value. Use any stock screener. You can filter for PB less than 1.0 in seconds. Step 2: ask yourself why. Is this a value trap, a cheap company that's cheap for a reason and will stay cheap forever? Or is this an actual opportunity? A bank with solid credit quality trading at PB 0.9 is very different from a struggling retail chain at PB 0.5. This is where you need to look at profitability. If a company trades at PB 0.8 but has negative earnings and is losing market share, the low multiple is a warning, not an opportunity. But if a company trades at PB 0.8 and has a return on equity of 12%, then it's actually generating solid returns on those assets. That's the kind of low PB that creates wealth. Step 3. Check the balance sheet quality. Are these assets real? Are they liquid? A manufacturer with $10 billion in equipment has different balance sheet quality than a retailer with $10 billion in inventory that might never sell. Benjamin Graham called this the margin of safety. When you buy $1 of book value for 50 cents, you're building in a cushion. Even if the company struggles for a few years, the underlying asset base protects you. Now, here's what absolutely destroys most investors who use PB: they forget that book value is only as reliable as the balance sheet. If a company's primary asset is intangible, a brand name, customer relationships, proprietary technology, book value is nearly meaningless. Apple trades at PB 57. Does that mean it's overpriced? No. It means the real value sits in the iOS ecosystem, the brand loyalty, and the ecosystem lock-in. Those aren't on the balance sheet as assets, but they're where the actual value lives. Conversely, an old coal plant might sit on the balance sheet at full historical cost, but in today's regulatory environment, that asset might be worth 10 cents on the dollar. The balance sheet says it's valuable. Reality says it's a stranded asset. The point P/B works beautifully for businesses where assets directly translate to profits: banks, insurance companies, manufacturers. It's misleading for software companies, franchises, and anything heavily dependent on intangible value. Here's the one principle that defines master investors: they understand the difference between price and value. Price to book is one tool, not the only tool, for finding moments when price and value are wildly separated. But it only works in the right industries, with the right balance sheet quality, and paired with real profitability. When all three align and you get a low PB in a solid asset-heavy business with good returns on equity, you've found what Graham called the margin of safety. That's when patient investors compound wealth. If you found this useful, subscribe to the Daily Investor so you don't miss the next concept I'm breaking down. Drop a comment: what's the lowest PB ratio you've ever seen in your portfolio? And tomorrow, I'm walking through how to calculate intrinsic value using just a balance sheet in 5 minutes of your time. See you then.